Welcome to the Deep Dive into Success podcast. Jason and Rebecca are ready to fuel your next move. Every insight here is a spark. Ignite change. Seize the moment. Take action today and shape your tomorrow. Check us out by listening. And if you like what you hear, don't forget to subscribe to receive notifications when new content is available.
Welcome to the Deep Dive. Today we're trying to cut through all the noise about personal finance. Our mission is to figure out the quickest, most effective path to actually building wealth. Which accounts, which strategies really put you in the express lane. We've dug into the source material to find those core drivers.
And look, if you're aiming for that express lane, you have to accept the trade-off, right? It's always a balance between wanting speed, high returns, and managing the risk that comes with different investments. The real goal isn't just maximum growth, it's sustainable growth. So you actually reach the finish line without, crashing out.
Okay, so how do we measure that speed? We have to start with maybe the most powerful concept for an investor, the rule of 72. This seems fundamental for understanding how fast your money actually doubles.
It really is. It's the benchmark, the thing that shows just how inefficient those super low return accounts are for long-term goals. The formula is pretty simple. The years it takes to double your money is roughly 72 divided by the annual rate of return. Remember to use the percentage number there.
Right. And the implication of that, it's kind of staggering, isn't it? The difference between a decent return and a great one isn't small.
No, it's huge. Generational, even. Think about it. An account making 4%. Your money doubles in about 18 years. But bump that return up to 8%, suddenly it only takes 9 years.
9 years.
Yeah. That 4% difference cuts the time in half. Literally. If that could be the difference between funding your kid's education or, struggling with your own retirement. So those low return accounts, fine for emergencies, sure. But for speed, not the answer.
Okay, so if the rule of 72 points to higher returns being crucial, does that mean we should just, gamble on really risky stuff? Speculative stocks, crypto maybe?
Well, not necessarily the riskiest route, but the most, let's say, subsidized route. That's where the real acceleration is. The top priority, based on everything we see, is maximizing your tax-advantaged retirement accounts. Your 401ks, your IRAs. These are just accounts. They offer tax benefits, deferred or tax-free growth. The government is essentially helping your money compound faster.
And the biggest accelerator within those accounts?
Oh, easily the employer match in a 401k. If you get one, that match, it's an immediate, basically risk-free, 100% return on whatever you contribute to get it. You just won't find a faster, safer initial return anywhere, period. Max that out first, always.
Okay, maximize the match. Got it. But we should probably mention the accounts that aren't the express lane, too.
Definitely. That's what we could call the bedrock. Your basic savings accounts, CDs, they're vital, for liquidity, for that emergency cushion, absolutely essential. But the speed, very, very low. They preserve money. They don't really grow it fast.
So where does the main growth capital go after the match?
For the bulk of your growth money, the sweet spot seems to be aiming for that stable historical market growth, maybe 7 to 10% range. That's usually achieved through diversification. Think low-cost total market index funds or ETFs. They balance risk and return for that steady compounding.
Right. But even the best fund doesn't help if you panic sell or don't contribute regularly. The sources we looked at were clear. The real accelerators might not even be financial products. What are those non-financial drivers?
Yeah, this is crucial. It really boils down to two things: self-discipline and lifelong learning. Discipline means consistency. Automating it helps paying yourself first, every single paycheck or month. Any interruption to that steady investing really messes up the timeline that the rule of 72 predicts. It pushes your goals further out.
And that discipline gets tested hard when markets drop, right? Emotional control must play a huge part.
Absolutely critical. You see it all the time. People lose years of potential gains because they sell in a panic during a downturn. Think about 2008. The disciplined investors who stayed put or even bought more did incredibly well over the next decade. But many sold low and missed the recovery. So discipline means tuning out the noise, sticking to your allocation, time in the market, not timing the market.
You also mentioned lifelong learning. How does that accelerate wealth?
Because things change. The financial world isn't static. Learning means understanding things like advisory fees. Are you paying too much? Are there new account types like HSAs, health savings accounts that offer amazing tax advantages? You need to keep optimizing to make sure you're still in that express lane and not getting slowed down by hidden costs or missed opportunities.
Okay, so wrapping this up, what this means for you, the listener, is that getting into the Wealth Express lane isn't about some secret stock tip. It's a formula. Grab that free 100% return from any employer match, prioritize those tax-advantaged accounts, use low-cost diversified funds for core growth, and crucially maintain unwavering discipline.
Exactly. And maybe the final thought is this. The truly fastest path isn't always about chasing the absolute highest possible return on paper. It's about finding the optimal level of risk for you. The highest return you can handle psychologically, allowing you to stick with the plan year in, year out, through thick and thin. That personalized commitment, that ability to stay the course, that's the ultimate accelerator.
Thanks for diving deep with us on this episode of the Deep Dive into Thriving Successfully. We hope you found a quick hack to take action on today. If this episode moved the needle for you, please take 1 second to hit that follow or subscribe button on your favorite podcast platform. It helps us reach more people who want to start thriving. Our content is 100% based on listener requests. We want to cover the topics you struggle with. Drop your episode suggestions in the comments or send us an email directly at deepdive@lfeg.info. And the best way you can help us is to share this episode